Well, greetings everyone, and welcome to the Argonaut monthly video covering July and the first few days of August 2024. Well, it was a fruity July with a change in market leadership in the US, where more cyclical, more leveraged, and smaller cap companies dramatically outperformed, with the Russell Small Cap Index rising 10%, while most other major equity markets were flat to modestly up. Now, the catalyst for this appeared to be the failed assassination attempt on former President Trump on July the 13th, with smaller, riskier, and domestic stocks being perceived beneficiaries of his then perceived higher probability of re-election. Now, this kind of momentum reversal into higher risk stocks is usually a signal of the economy coming out of rather than going into recession. And as we've seen in the first few days of August, sentiment has now changed and the market is worried again about an imminent US recession. Now, the fund lost 3% in the month, with short squeezes in riskier US stocks the main detractor. For more details on this, please refer to our July monthly fact sheet. Also in August, global equity markets have hit a liquidity air pocket, and we're going to talk about why that may have happened in more detail. Now, the US labour market has shown some initial signs of weakness, with the unemployment rate rising from 4.1 to 4.3%. Q2 corporate earnings have also highlighted a mixed consumer outlook. Although not inevitable, I now think there is a reasonable possibility of a significant economic downturn. Now, if we do get a recession, I think it will be similar to that experienced in 2000, where credit stayed resilient and banks proved defensive. This will be more about huge misallocation of capital into useless industries, then the dot-com bubble, now net zero, and possibly AI. Now, although the immediate cause of recent equity market weakness seems endogenous to financial markets, the weakness in stock prices could start a negative feedback loop to the real economy. Now, although the Federal Reserve held rates in its meeting at the end of July, Fed Fund futures are currently pricing in a 90% probability of a 50 basis point cut from the Fed in September, subsequently followed by 25 basis point cuts at each of the subsequent 3 meetings. It's our view that equity markets could be in a liquidity air pocket until we get a response from the Federal Reserve. Now, we're going to offer some observations as well as update on how we intend to navigate these treacherous waters, where we've already seen quite a lot of opportunities from illogical dislocations over the last few days. Now, why is Japan at the center of this global liquidity crisis? Well, from 2016 until earlier this year, Japan had a negative central bank interest rate. And the interest rate differentials between Japan and the rest of the world, in particular the US, had encouraged what's called a carry trade, whereby investors could borrow cheaply in yen and fund higher yielding or speculative asset purchases elsewhere. Now, this trade only worked as long as the Japanese currency stayed weak, which was also dependent on the interest rate differential staying. So Japanese interest rates staying lower than other interest rates in the rest of the world. Now, from the beginning of the year until its July 10th low, the yen had weakened 10% against the dollar, enhancing the overseas returns for Japanese investors and the returns for anybody who had borrowed in yen to fund these trades. But on the 31st of July, the Federal Reserve held interest rates, but signaled that the bar was low for their next meeting in September to cut rates, whilst the Bank of Japan increased its interest rate from 0.1% to 0.25%, also signaling a further normalization of rates ahead. In other words, interest rate differentials were narrowing, which was less bearish for the yen. Now, this is important for global markets, since Japan is currently, and has been for the last few decades, the largest creditor nation in the global economy, with over 10 trillion in overseas assets, or 3.3 trillion net. And now, in less than a month from the July 10th low, the yen has strengthened nearly 12% against the dollar, wiping out nearly all of its year-to-date losses. Now, Japanese overseas investors, or any investors who had engaged in this carry trade, were now losing, and they needed to liquidate assets fast to pay back or post collateral to their creditors, what is known in the industry as a margin call. So volatility in the foreign exchange markets has caused volatility in global equity markets. In just 3 days, global equity markets have fallen 10%. And on Monday the 5th, the Japanese stock market fell by over 12% in a single day. Now, this is highly unusual. Subsequently, on Wednesday the 7th of August, the Bank of Japan provided some short-term relief by suggesting it will only continue to raise rates when market volatility calms down. Now, one thing I noticed in July was that all of the consensual winning trades of the first half of the year actually reversed momentum in July, often falling more than the market. So from their July highs, Japanese stocks have fallen 25%, copper has fallen 18%, semiconductors have fallen 23%, GLP-1 drug companies have fallen 15%, and Magnificent Seven stocks have fallen 13%. Now, when bull market leadership fails, it can be a worrying sign that global financial markets have run out of liquidity, and there are no more buyers for the obvious trades. And this is the start of a devil take the hindmost bear market in so-called glamour stocks, stocks that are sustained by their narrative more than their valuation. A so-called Minsky moment made famous by an economist who otherwise had nothing useful to say. Now, we find many reasons to doubt the bull thesis for copper and copper miners, many reasons to think that the share prices of GLP-1 drug companies have run too far, but we're going to focus specifically on the bullish AI thesis and expand on our comments from last month as to why this might be overhyped. So we noted previously how it was easy to confuse the advances in processing power, allowing computers to look for correlations in vast quantities of data, with the human ability to offer explanations based on causation. But fears of being left behind mean that most businesses and governments want a dog in the AI fight, fueling a boom in semiconductor content and data centers, even though the actual pace of true AI innovation may ultimately disappoint. Now let's look at Nvidia, which has a dominant market share in manufacturing GPU chips, originally used in video games, but now used in data centers to handle massive data sets and complex computations for AI. Now, Nvidia's data center revenue was just 15 billion in its financial year ending January 2023. So that's approximately 2022 calendar equivalent. It increased 32 billion the following year, the 47 billion, i.e. up more than 200%, and is estimated to be up 58 billion in this calendar year to 105 billion, i.e. up 120%. It's then forecast to keep growing another 45 billion next calendar year to 150 billion. So a slower rate of growth, but that's still a lot of dollars being spent on GPU chips. Nvidia's estimated annual revenues to January 2026, so the 2025 calendar year, have risen by 127 billion since the beginning of 2023, from just 40 billion to 167 billion today, meaning that AI data spend has gone from 55% of Nvidia's total sales in 2022 to an estimated 90% in calendar year 2025. So it's certainly been a boom, but it's worth pointing out that Nvidia is highly reliant on just four companies: Amazon, Meta, Alphabet, and particularly Microsoft, which account for over half of its revenues. And such client concentration is not normally a good sign of sustainability of growth. All it takes is a couple of CEOs to change their mind. Now, these four hyperscalers, as they're known, increased their capex from 60 billion in 2024 calendar year from a combined 136 billion to 197 billion, and are estimated to increase capex by 35 billion in 2025 to 232 billion. So it's an amazing amount of money being spent on AI and data centers by just four companies. So at the beginning of 2023, the market estimate for capex for these hyperscalers was just 154 billion. In other words, 2025 hyperscaler capex has been revised up by 50% in the last 18 months. And this is, of course, responsible for the boom in Nvidia chips and in AI generally. But Q2 hyperscaler conference calls were pretty unconvincing in addressing investor concerns around whether this capex or investment will actually generate sufficient new revenue streams in the foreseeable future. Let's look at some of the comments. Now, Alphabet CEO said the risk of underinvesting is dramatically greater than the risk of overinvesting for us here. Even in scenarios where it turns out that we are overinvesting, they have long, useful lives, and we can work through that. Okay, they can work through it, but what happens to Nvidia revenues whilst they're working through the overinvesting? Mark Zuckerberg, the Meta CEO, said, "I'd rather risk building capacity before it's needed rather than too late, given the long lead times." And Elon Musk said on the Tesla call, "In the benign AI scenario, we're heading for an age of abundance where there's no shortage of goods and services and anyone can have pretty much anything they want. Whatever Elon's smoking, I want some of it." It's worth noting that at the beginning of 2023, revenue revisions for 2025 for these four companies have increased by just 4% and have actually fallen by 9% since the start of 2022, meaning that that capex to sales ratio has increased from 10 to 15% in the last 2 years. So a lot more investment, but where are the extra revenues? Now, investors won't have unlimited patience for revenue and profit generation from this capex that appears to have no immediate return. And if the share prices of the hyperscalers begin to underperform for whatever reason, that could be recession, it could be doubts about whether they're getting a return on their capex, then pressure will build on their CEOs to moderate investment in AI, and that will turn a boom in capex for Nvidia into a bust. So we've seen how Nvidia is dependent on the hyperscalers continuing to grow AI capex at rapid rates. It's also dependent on continuing to dominate the market and there being limited competition. And it really has to develop new customers beyond these four hyperscalers. And once the rate of revenue growth slows, Nvidia will soon find itself with an inventory glut, a loss of pricing power, and in that scenario, revenues will fall by more than 50%, and the company will probably be unprofitable. It's worth remembering that Nvidia has always been a cyclical boom and bust stock, and bust will follow boom as surely as night follows day. And the difficulty is working out when this will happen.